Welcome back, participants. After a very interesting discussion on the area of the trade, there has been another area which is again equally interesting, that is accounting and finance. Obviously, you must be wondering that once you trade, once you produce, or once you invest, all these things must be converted into the accounting areas, or how the finances or treatment of the finance is being taken care of. So you do have certain formalities, you do have certain logic, you do have certain rules for the accounting treatment of the transactions. There are principles, there are rules. All these things indicate that how accounting transactions to be taken care of. In order to deal these accounting transactions, principles, philosophy, presentation style, we have Dr. Sunil Gupta, who is a faculty member in the School of Management, Indira Gandhi National Open University. Now Dr. Sunil Gupta will be discussing all these things, but I request you all that you must be proactive as well, because you are going to learn these aspects. So whenever you have any questions, any queries, you are most welcome to ask the questions and we'll be happy to respond to you. Now, Dr. Sunil Gupta.
Well, students, first of all, I must extend my sincere thanks to Professor Kishore for introducing me and giving me a warm welcome. So, students, today we are going to discuss basically the main fundamentals of accounting, which are very, very necessary for an entrepreneur or for a businessman who is going to deal with lot of transactions which are going to take place during a financial year. So here, well, students, before I go ahead, I would like to make it very clear that in case where you do have any doubt, any problem, any confusion, so you please don't hesitate. You should come forward, you should have your queries. I shall be very happy while answering your question. See, in case where you are listening me, but in case if you are not asking your questions, where you do have certain doubts in your mind, then definitely I think that it will defeat the purpose of mine and as well as the purpose of you people also. So you should be very alert, you should be very active, you should listen the lecture properly, and in case where you come across any doubt, I shall be very happy to answer your questions. So you should not hesitate at all. See here, you know that in the early 90s, when the accounting system was not properly developed, and you know it was when in rudimentary form, only a limited number of transactions were there which were to be recorded in the books of the accounts during a particular financial year. So when the transactions were limited in number, therefore only the limited number of books were required just for recording the transactions in the books of the account. So it was quite easy and it was very simple for an entrepreneur or for a businessman or for the proprietor to keep the record of this limited number of transactions, and one can have the accurate picture of these transactions as and when the informations were required. But with the passage of the time, with the advancement of the technology, with the change in taste and preferences of the customer, change in conditions, change in business environment, the circumstances also get changed. So here you know that innumerable transactions are going to take place during a particular financial period, and really it becomes impossible for the entrepreneur to remember all these transactions. Therefore, it is the necessity of the accounting system to place, and we need a system where these transactions could have been recorded properly and the true and fair picture of a business could be easily revealed as and when it is required. So for that purpose, here this system of accounting, it came into existence. And you know that when we talk about accounting, so very simple, all the transactions, business transactions rather I must call it, that which are going to take place during a particular financial period, they have to be recorded in order to have a net result of these transactions at the end of a particular financial period. So here, as per the American Institute of Certified Public Accountants, the definition or the meaning of the accounting is very much clear, that accounting is the art of recording, classifying and summarizing the business transaction in a very significant manner and in terms of money. The transactions and events which are in part at least of financial character and interpreting the result thereof. So simply if I go through this definition, so I find that this accounting definition is basically bifurcated in these 3 and 4 parts. That first, accounting is the art of recording. So here you see that it is the art of recording. So as I have already told you that every business transaction has to be recorded in the books of the account. See, when the business was not in proper or not in developed form at that time of system, it was not essential to record the transactions because the transactions were very limited in number, and it was easy, it was simple for the organizer, it was very simple for the entrepreneur to remember all these transactions. But these days the transactions are going to be increased very fast, and really it becomes impossible to remember these transactions. Therefore the necessity of recording the business transactions took place. So this is the first part of accounting definition, that accounting is the art of recording. So well students, recording the business transactions in the books of the account is not going to serve the purpose of the proprietor, of the government or the investor or the shareholder or the employees or the tax authorities, because simply if we are recording the transactions, and if all these transactions are not converted into a meaningful manner, these will not serve the purpose of the interested parties which have a common interest in the business. Therefore it is these transactions which have already been recorded in the books of the account during a particular financial year have to be classified. Say for example, I record number of transactions which are directly connected to the business, like purchase transactions are there, like sales transactions are there, like cash transactions are there, like credit transactions are there, purchase return transactions, then sales return transactions. So lot of transactions took place during the accounting period. But when I didn't classify these transactions, so in case if somebody is interested to know the exact result of a particular nature of transaction, then I think it will be next to impossible to have the idea to have a fair and exact picture of that transaction. See, for example, if somebody is interested to know how much cash purchase or how much credit purchase I have made during a particular period, so I think it will be very difficult for a person to answer such question unless the business transactions which have to be recorded in the books of the accounts are properly classified. Therefore, it is all the transactions which are of similar nature, like purchase transactions, like sales transactions. So purchase transactions, students, again we have two things to record the purchase transactions. We may have the cash purchase, we may have the credit purchase. So here, for that very purpose, in order to classify the purchase transactions in these two parts, like cash purchase and credit purchase, again we have a purchase book and we have a purchase account. So again the question arises that which transactions will be recorded in the purchase book and which transactions will be recorded in the purchase account. So many times I have found that the students get confused while recording these transactions. Say, when I purchase 20 articles against cash, so when the cash is involved, so here I have told you two things, that purchase account and purchase book. So very simple, here purchase account is a broader term rather than the purchase book. So when we are going to record the purchase transactions like credit purchase, then it will be recorded only in the purchase book. But so far as the purchase account is concerned, so all the transactions which are related to purchase, whether that purchase is on cash basis or whether that purchase is on credit basis, so all the transactions relating to the purchase will definitely find a suitable place in the purchase account. And when the credit purchase transactions are there, then simply they will find a suitable place only in the purchase book, not in the purchase account. So students must be very clear about these types of transaction, so that at the time when somebody is interested to know the exact figure of purchase, of cash purchase or of credit purchase, so definitely in case where we classify this transaction in the purchase book and in the purchase account, definitely we will be in a position to answer such question well in time. So therefore student must be very much clear about the classifications of the transaction. Likewise, sale transactions are there, credit purchase return transactions are there, sales return transactions are there. So in order to know the exact picture of the different transactions of different nature, we should classify the transactions so that we can have the exact figures, we can have the accurate figure of these transactions, and we can answer the questions of the interested parties well in time without any problem. Then the next one is summarizing. So again students, see, when we classify the transactions according to their nature, then again I think it is not going to serve the purpose of the interested parties. See, nobody is interested to know how much sales or how much purchase I have made during a particular period, and nobody is interested to compare the purchase or to compare the sales of one period to another, because if I say that I have made a purchase of 2 crores this year as compared to rupees 1 crore last year, or I have made a sale of 5 crore this year rather as compared to 2 crore last year, so this is not going to serve the purpose of the investor or to serve the purpose of the interested parties which do have a common interest in the business, because finally they have the exact picture of profitability and the financial position of that business concern. Because if somebody is interested to invest his funds in a particular organization, then I think purchase and sales, these kinds of informations are of no use for the investor in order to take the decision of investment, because here the profitability and the financial position is far better than to have the informations regarding purchase and sale. So if I want to know the financial and the profitability position of a particular business concern, then I need to have a different kinds of information so that I can take a right decisions based on the information available. So here, in order to summarize these transactions which we have already recorded, then classified, so we have the final accounts like trading, profit and loss, and balance sheet is there. So for that very purpose, when we prepare a trading account, so that every account has two sides. One side is known as debit side and the other side is known as credit side. So now the question arises, what actually the debit and credit side is all about? So very simple, the left hand side of any account is known as debit side, where all the direct expenditures which can easily be attributable to the cost of the product will be recorded in the debit side of the trading account, and the right hand side is known as the credit side, where the direct incomes, the sales revenues, such transactions have to be recorded. And in case where the credit side is more than the debit side, it means if the credit side is in excess than the debit side, definitely we will have the gross profit, and vice versa. That is, in case where the debit side is in excess, then the credit side of the trading account we will have a gross loss. So again, while taking the profitability and the financial position of a business concern, gross profit and gross loss, this is not the ground, this is not the base, this is not the parameter on the basis of which one can abstract a right decision. So again, we will have to go through the profit and loss account and the balance sheet for taking a right decision. So well students, when we discuss about the profit and loss account and balance sheet, very simple, again as the name implies, profit and loss account. So again we have a two side of profit and loss account. One is a debit side and another one is credit side. So the left hand side of the profit and loss account is known as debit side and the right hand side is known as credit side. So in the debit side of profit and loss account, all the indirect expenditures are recorded, like you may have the printing and stationery, you have paid the salary to the staff, maybe the insurance expenses, maybe the bad debts, like if you have extended the credit to your customer, so in that case whatever amount which you could not realize from your customer on account of extending the credit, on account of enhancing your profitability, on account of enhancing your sale, but at a later stage when the due date comes and the amount could not be realized from the debtor, that amount is known as bad debts. So that amount is also a loss. So any indirect expenditure and loss which took place during the accounting period, that will be recorded in the debit side. So far as the credit side is concerned, so you may have the revenues or gains during a financial period. Say for example, you have an asset of rupees 5,000, but you disposed of that asset against rupees 7,000. So this profit of rupees 2000 which you have earned on account of transferring the asset during the financial period, so the profit, this gain of rupees 2000 will be recorded in the credit side. So here, when the credit side is in excess of the debit side of the profit and loss account, again we will have a net profit. And if the debit side is in excess than the credit side, then we will call it a net loss. So here again, when we have to take a financial decision about a particular business concern, it is not only the trading account, it is not only the profit and loss account which have to be studied, rather profit and loss account and balance sheet. There are other financial statements, like we may have a working capital, we may have a funds flow statement, we may have a cash flow statement, we may have a standard costing system, we may have the marginal costing system, we may have the budgetary control. So many tools and techniques are there which need to be studied at right time while taking a financial decision. So again, if I say that I have a profit of rupees 10 crore this year as compared to rupees 7 crore last year, so again it is not going to give a very fair picture about the financial position, because it is not only the profit which matters, rather the financial position, the fixed assets, the liabilities, the share capital, the fixed liabilities, the current liabilities. So many things are there which need to be studied during a course of time when in order to abstract a financial position of a business concern. So here, for that very purpose, one need to study the balance sheet. So here, balance sheet, I would like to make the students very much clear that balance sheet is not an account. Balance sheet is simply a statement, like we call it that trading account is there, profit and loss account is there, but so far as the balance sheet is concerned, we cannot call the balance sheet as an account, rather the balance sheet is a statement. So basically, the difference between the profit and loss account and the balance sheet, that profit and loss account is prepared for a particular period, rather than the balance sheet is prepared on a particular date which reflects the assets and liability position of a business concern on a particular date. So here the balance sheet provides the information about the fixed assets, about the current assets, about the share capital, about the fixed liabilities, or about the short-term liabilities. So, well, students, when we say that fixed assets and the current assets, the students might be interested in knowing that what in fact the fixed assets and the current assets is all about. So you know that students, when we are running a business and when we do have a business in the course of the time, there are certain assets which we need to maintain during the financial year in order to meet the short terms obligation. Sometime what happens that we may have a large amount of profit, huge amount of profit, but the business concern may have the problem of liquidity. So in case where the earning potentiality of a business concern is very sound enough, so it may not necessary that the liquidity position of a business concern may also be very sound. Sometimes many business organizations are suffering the liquidity problems, and consequently when at the time of AGM, when they have to declare the dividend to their shareholder, they face this type of problem, that despite being the huge amount of profit which they have earned during a particular period, still they are not in a position to declare the amount of the dividend to their shareholder. So therefore it is when the amount is retained by the business concern in order to meet out the short-term obligation. So again students, here the question arises, what in fact this short-term obligation is all about. Sometimes we may have short-term obligation maybe for 6 months, maybe for 1 year, maybe for 2 years. So here what is the amount of period which exactly bifurcate the short-term obligation and the long-term obligation. So here when we talk about accounting system, so in accounting terms, the short-term obligations are those obligations which have to be met out during a period of 1 year, or any obligations which are to be met out for more than 1 year. Such obligations are known as long-term obligation. So for that very purpose, sometimes what happens that the business organization, they are very conscious about the liquidity positions, and on the other hand the other organizations are very conscious about the profitability position. So these two terms, profitability and liquidity, these are very important terms, and the business organization has to strike a judicious balance between these two, so that the profitability position of the organization should not be affected at all, and the liquidity position of the organization should also be very sound enough. Because when we may have more liquidity, that will definitely affect the profitability of that organization adversely. It means that we are not optimally utilizing the amount, and the amount is already lying with us idly, and we are not properly exploiting the resources, we are not properly utilizing the funds available with us. So what will be the consequences? Then there is no doubt that we can easily meet out the short-term obligation. We don't have any financial problem, and as and when the short-term obligation arises, definitely we can honor such obligation. But the problem arises that in case where the excess funds are lying with us idly, we are not exploiting and properly utilizing, that will affect the profitability adversely. Because the funds which are lying with us idly, if the same amount of funds could have been invested somewhere else, then definitely we could have a reasonable rate of return, which now we have to forego just on account of lying the funds idly with us, because we are extra cautious, we are more cautious in order to meet out the short-term obligations well in time. And on the other hand, if we are more bothered, if we are more conscious about the profitability and what are the funds which are available with the business organization, if the entire fund is blocked in the fixed assets, it means the funds have been utilized, the funds have been blocked in the fixed assets for a longer duration, just to have a better productivity, just to have a better profitability. But this situation may also be very dangerous for the business organization, as I have already discussed that sometimes the organizations which are earning huge amount of profit, they are performing like anything, but the problem which such organization may face, that they may have a liquidity problem. See, sometimes if I have extended the credit, short-term credit to that organization, say for a period of 2 months, and when the period of 2 months is over, and when I go to that organization, and if I ask that organization to make my payment, and if that organization says, okay Mr., we are not in a position to make your payment right now, you please extend this credit facilities for a period of 1 week or for a period of 2 weeks. So then definitely it will give me a very bad impression that this organization is enjoying a very good rapport in the market, but the fact is lying somewhere else, because they are not in a position to make the short-term obligation well in time. So I'll spread this information in the market, that though they are earning huge amount of profit, but their profitability position is not good enough, so the other persons who may or who may not have the idea to invest their fund in that particular organization, maybe that the persons who are interested to invest their funds just on account of a sound profitability of that organization, they can change their decision and they can switch over to the another organization just because of the liquidity position, because there are some investors in the market who do expect a regular and certain return from their investment. So these type of investors are known as small investors. Like sometimes what happened that the government persons who got retirement from the organization, so after the retirement they need a certain and irregular income. So in case where the liquidity position of the organization is not sound enough, so then definitely that organization will not be in a position to make the regular payment to those investors. So then definitely the faith of such investor will let down and they will no more be investor for that organization in the time to come. So this is that what the students we are explaining, we are discussing here. So here students, in case where you do have a problem where you are not in a position to get my point, you are always welcome, you can have your question, so I shall be very happy to respond your question. So next one is financial character. So here when we say financial character, so there are many transactions which are of non-financial in character also. So such transactions are also very important for the entrepreneur as well as for the other persons who do have a common interest in that particular organization. Say for example, if the organization has got a team of very dedicated staff, very intelligent staff, very healthy staff, very sincere staff, then definitely this is a very big asset for that organization, and the organization will be performing like anything. The profitability and the financial position of that organization will be very sound enough, because the employees, because you know that the human resource, if the human resource of organization is very sound, the performance of that organization will also be very sound. So it is essential that every organization must have a team of very dedicated and very trustworthy staff, so that they can contribute maximum, so that they can exploit the resources of that organization in a very nice manner, so that the profitability, the productivity of that organization may go very faster. But again here the problem is that this transaction, we cannot express this transaction in the monetary term. So this is a big limitation in the financial statements and for the entrepreneur. Since they have got a team of very dedicated staff, it's no doubt a very big asset for the organization, but this big asset cannot be recorded in the books of the account. That is why only those transactions which can easily be expressed in the monetary terms will find a suitable place in the books of the account. Say for example, if I say that I do have a material of 600 kg, I do have 2 motor cars, I do have a furniture, then I think these kind of informations are of no use, neither for me nor for the other persons who do have their common interest. But on the other hand, if I say that I have a material of rupees 600, if I have 2 motor cars worth rupees 3 lakh, if I have a furniture of 70,000, then definitely this is a meaningful information for the persons who have got common interest in that particular business concern. Therefore, it is only those business transactions which can be expressed in the monetary terms will be recorded in the books of the account. So this is a big and very big limitation on the part of the accounting system, that it ignores, it avoids those transactions which are non-financial in nature, since the utility, the significance of these non-financial transactions may be of very high. That is why the transactions having the financial accessibility will be recorded in the books of the account. Then, interpreting the result thereof. So here, when we say that interpreting the result thereof, very simple. Here, the transactions which we have already recorded in the books of the account, then we have classified these transactions, and then after classifying, summarizing the transactions, it means giving a very meaningful shape in the financial statement, that is profit and loss account and balance sheet, and then interpreting the result thereof. So the transactions which we have recorded and given a meaningful shape in the form of profit and loss account and balance sheet, then the transactions of more than 2 years, maybe of 5 years, maybe of 10 years, may be compared, that is the transactions of 1 year may be compared with the transactions of another 4-5 years, so that we can have a comparability positions of the financial statement, so that we can interpret that the how much the profit, or how much the current assets, how much the current liabilities, how much the fixed assets, and how much the fixed liabilities have gone up, or the assets and liabilities have come down over a period of time. So if we say that the fixed assets have been increased from one period to another by 10% or 15%, then definitely it will carry a meaning. But if I say that the current assets have gone up, or the current assets have come down by rupees 1,50,000, it simply means that expressing the business transaction in the absolute manner will not carry any meaning, will not serve any purpose of the interest of the investor or of the interested parties which have a common interest in that particular business concern. Therefore, the business transactions should be expressed and interpreted in a manner then so that they can give a right and true and fair picture about the financial and about the profitability position. Say when we say liquidity position, so for that very purpose we need to analyze the liquidity ratios, like we have a current ratios where only the current assets and current liabilities have to be taken care of, and sometimes when we say that we want to know about the profitability position of a particular business concern, then definitely we must be focused, we must concentrate more on return on investment, earning per share, return on shareholder funds, then price earning ratios. So these are the few ratios on the basis of which we can take a right decision about the profitability of that organization. But so far as the liquidity position is there, then we need to discuss, we need to find out the current ratio and the liquid ratio of that organization. Therefore, in order to have a true and fair picture of different aspects of the organization, we need to study the different aspects. Like for profitability, we need to study the return on investment, shareholder funds, and other ratios which I have discussed with you earlier. So here, next one is the accounting principles. So students, accounting principles, accountings, when we talk about accounting system, so any system is based on principle. So same is the case here with accounting system also. So accounting system is based on certain principles. So when we say that accounting principles, the very next term that comes to our mind is accounting concepts and accounting convention. So here what actually the accounting concepts are all about. So when we say and when we discuss about the accounting concepts, so very simple, accounting concepts include those basic assumptions upon which the science, the entire system of accounting is based. And so far as the accounting conventions, as the name implies, that it includes those traditions and customs which simply guide the accountant while preparing the accounting statements. So here we need to study what are those accounting concepts and what are those accounting concepts. So in order to have a brief idea about the accounting concepts and convention, we see first accounting concepts. These are separate entity concept. The first one is separate entity concept. So students, sometimes I came across number of students who are not very much clear about the separate entity concept. Actually, the separate entity concept here is that the entity of the proprietor is entirely different than that of the business. Say for example, if I started a business investing rupees 2 lakh, it means that I have invested rupees 2 lakh in the business. So this amount of rupees 2 lakh which I have invested in the business, so this amount of rupees 2 lakh I have given it to the business as a loan, which will be shown in the liabilities side of the balance sheet. And say during the financial year, if I withdraw rupees 50,000 out of rupees 2 lakh, that simply means that the net liabilities of the proprietor will be rupees 1,50,000 because I have withdrawn rupees 50,000 during the accounting period. So that is that where the proprietor entity is entirely separate than the business entity. Second one is money measurement concept. So that I have already discussed with you, dear student, that only the transactions which can be expressed in the monetary terms will find a place in the books of the accounts. Third one is the cost concept. So when we discuss about the cost concept, very simple, that any asset will be recorded in the books of the account against the price which we have paid to acquire it. Maybe that at that time the market value of that asset may be more than, maybe less than the price which we have paid. So it's hardly matter what is the market price of that asset. We have paid rupees 50,000 rupees to acquire that asset, therefore we should record that assets against rupees 50,000. That shows that this cost is the base for all the subsequent accounting period, and it does not mean that the asset will always be recorded against rupees 50,000 in the books of the account, because with the passage of the time the asset will get depreciated and ultimately the market value of that asset will be reduced, and automatically the book value will be shown in the books of the accounts against its depreciation. Next one is realization concept. So again, very simple. When we talk about a realization concept, so here the revenue is recognized to be made at a point not at the time of accepting the order, rather than when it is executed. At that time the revenue is recognized to be made. Thank you students.
So accounting principles and accounting concepts facilitate the understanding of accounting and finance. This is the basic area of accounting and finance. So you must understand all these areas of accounting. Thank you very much, Dr. Sunil, and thank you all the participants.